Well, apparently the US housing market is not the exception when it comes to falling home prices. Residential real estate across the world are all going down. First time it's happened in 10 years. For our US housing market, we've had 124 weeks of prices going up. That dates all the way back to Feb of 2012 to June of 2022 this year, or I'm sorry, the past year. Now we've seen 4 straight months of home price declines. According to the Case-Shiller Index, home prices declined by 2.4% between June and October of 2022. They said that this is the second biggest decline since World War II. While it's nothing compared to the mortgage meltdown, they still think it's significant. As we head into 2023, one of the most important questions is just how much of the pandemic housing boom's historic 41% plus jump in US home prices, which has slipped to 38% by the way as October of 2022. How much of that will get erased? It is still too early to say for certain, but there are a few key factors that could play into determining whether or not this trend will continue, this downward trend. Many people are interested in knowing what the future holds for our national home prices. To get a better idea of what's coming for the national home prices in 2023, Fortune magazine talked to 27 of the nation's leading housing experts. 4 experts predicts US home prices to grow in 2023, but the other 23 said that they expect it to fall even further. Let me share with you what these 27 had to say and also give you my own comments on some of them. Let's start with the 4 positive ones first. The most bullish of them all, Realtor.com. It said that existing home sales price will continue to increase by 5.4% in 2023, while mortgage rates will be around 7.4%. This doesn't seem to be right to me. If interest rates go or stay above 7.4%, I truly believe that we see more home buyers get priced out of the market. As a result, we could start seeing more pricing pressures. Next, we have Home LLC. The firm predicts US home prices to increase by 4% in 2023. This is because of the following that they mentioned. Tight supply of existing homes, the Fed likely ceasing to raise rates, and very low foreclosure risk. They also said that unaffordable and overbuilt cities are at significant risk for correction. This one to me makes more sense. If you follow the channel, you know that I have said over and over again that inventory is our problem. Also, like them, I believe that the Feds will stop the rate hikes, which could lead to the mortgage rates either stabilizing or better yet, going down. And yes, some of the overbuilt cities in Arizona, Texas, Florida, Nevada, etc. are already seeing significant corrections. Next, we have CoreLogic. They are predicting an increase of 2.8%. If you want to know more about CoreLogic's prediction, I highly suggest checking out their website. They share a lot of charts and graphs with their analysis. For the purposes of this video, I'm just going to say I agree with them. Next, we have our association, NAR, or National Association of Realtors. The projection is an increase of 1.2% in 2023 for home prices, and mortgage rates will average around 6.3%. I think that this is a more likely scenario that I see moving forward. Next, we have Freddie Mac. They are saying that home prices will fall slightly by 0.2% in 2023. With Freddie Mac, NAR, CoreLogic, and Home LLC, I believe this is our range for next year, slightly down to a high of just below 5%. Okay, continuing on with the negative forecast now. Mortgage Bankers Association. The firm's latest forecast has U.S. home prices as measured by FHFA US home price index falling 0.6% in 2023 and another 1.2% dip in 2024. The group also forecasts an average mortgage rate of around 5.2 in 2023 and 4.4 in 2024. This is what they said. Inventories of new homes are increasing at the same time that demand has remained quite weak, and more builders appear to be offering price cuts as well as other concessions to move properties. The thing I do not agree with this is their mortgage rate projection. Although I have to tell you that these are the experts that actually deal with mortgage rates day by day. So I'll err on the side of caution. But I gotta tell you, 5.2% for 2023 seems slow at the current pace that we're going. There could be 2 things here. One, we see the Feds radically shift and just cuts rate drastically, which I doubt. And the second is that they could be saying that the spread between the Fed funds rate and the mortgage rate could be narrowing. Historically, that spread is around 1.7%, if I remember correctly. Right now, it's almost double, mainly because of so much uncertainty and risk in the market. Next up, we have Zillow. They said that U.S. home values will fall 1.1% from November 2022 to November of 2023. I don't necessarily disagree with them. For me, anything within the negative 3% to an increase of 5% seems likely for next year. Next, we have Fannie Mae. Economists at the firm predict that U.S. home prices, as measured by the Fannie Mae HPI, will fall 1.5% in 2023 and another 1.4% dip in 2024. Fannie Mae is currently modeling an average 30-year fixed rate mortgage of 6.3% in 2023 and 5.6% in 2024. I'm okay with this projection. This is still within reason and I could see happening. Next, we have Redfin. Here's an interesting thing that they said that gives us an insight on why such as myself and other real estate professional is not totally bearish on the housing market. Here's what they said. The firm's baseline forecast predicts that the median U.S. home sales price will fall 4% in 2023. Prices would fall more if not for a lack of homes for sale. We expect new listings to continue declining through most of the year, keeping total inventory near historic lows and preventing prices from plummeting. To be brutally honest with you, this is the biggest key and still is the biggest challenge. Lack of inventory. And the lack of inventory is also our support when it comes to home prices not crashing. Next is Amherst. They are a real estate investing firm. They own a lot of single-family homes across the nation. You should also check out their website. Very interesting company. To solve their supply issue problem, they actually started building their own homes in factories, manufactured homes. Anyway, they forecast home prices falling by 5%. Interesting to note here is they cited increasing income as one of the reasons that is also supporting home prices from crashing. In essence, they are saying that even at these elevated levels, people can still afford to buy homes, which I kind of subscribe to also. Next up, we have Wells Fargo. Here's what they have to say. Markets where home prices shot up at the highest are now vulnerable to a disproportionate swing to the downside, notably in previously white-hot markets in the Mountain West, which saw an influx of remote workers at the onset of the pandemic. Home prices in desirable locations with comparatively tighter supply are likely to hold up better. You know, I totally agree. In places where they had a lot of in-migration because of the pandemic, those places, as well as vacation areas, will probably experience big declines because in-migration will slow down. Well, technically, it's already slowed down. Next up is Capital Economics. The firm's forecast model has U.S. home prices falling by 8%, primarily because of higher mortgage rates, a weaker economy, and prices falling earlier than expected. I think with these guys, they are seeing prices fall faster than what they originally forecasted, and that's why the 8% forecasted number, down 8%. Next is Goldman Sachs. For them, it's between 5 and 10% decline, but the official number, if you will, is 7.6%. They say that there are risks that the housing market could decline more than the model suggests. If you have access to Goldman Sachs report, I think it's worth reading. These guys are usually spot on with their analysis. Next, we have ING. They told Fortune it expects U.S. home prices to fall between 5 and 10%. However, this could be as high or should it be as low or as a decline of 20% basically. That's 20%. That's huge and scary. ING said that the housing market downturn triggered by the rapid increases in mortgage borrowing costs continues to cause us significant concern. Prices have risen hugely over the past couple of years as demand vastly outstripped limited supply of homes, but this process is going into sharp reverse with mortgage applications for home purchases falling by nearly 50% on the Q3 2020 peak. At the same time, there is more supply appearing on the market and the risk we see a steep correction in prices. I do not know what supply they are talking about here. Look, here's the thing. Inventory is forecasted to increase because homes will take longer to sell. But when compared to historical data, we are still below our needed inventory levels. I'm not saying they're wrong. I'm just asking where is this inventory that they're talking about coming from? Next, we have Bill McBride. Bill McBride from Calculated Risk. He expects U.S. home prices to fall by around 10% from 2022 peak. He says since national house prices increased very quickly during the pandemic, up over 40%, it seems likely that some of the usual stickiness will not apply. I think the most likely scenario now is nominal house prices declining 10% or more from the peak, and real, adjusted for inflation, house prices declining 25% or so over the next 5 to 7 years. I gotta tell you, this is a big yikes. We are getting into really scary territory here. Bill McBride has an interesting blog about home prices. He believes that we are in for 7 years of purgatory, or basically just in limbo for the housing market. Next, we have Ruben Gonzalez from Keller Williams Realty. He is our chief economist. He is forecasting a decline of 10% from top to bottom. Bottom being the first half of 2023. But he gives a caveat. It all depends on the Feds. Next up, TD Bank. They are forecasting a 10% drop. 5.7 in 2023 and another 2% in 2024. According to them, 2024 is when we start seeing price growth again. It's worth noting that this downward forecast was revised from 7.5% back in September of 2022. Next up, we have Morgan Stanley. They expect home prices to fall by around 10% between June 2022 and the bottom in 2024. They also said that should mortgage rates fall by more than expected, then it could only be a 5% decline. Here's another thing that they mentioned. The fact that we expect home prices to start falling on an annual basis in March 2023, despite tight inventory, reflects how unprecedented this affordability situation is in the U.S. housing market. However, although supply doesn't keep home prices growth or floored at zero, we do believe it prevents home price declines from becoming too large. There's our common denominator, supply, lack of supply to be specific. Next, we have Moody's Analytics. Again, another firm looking at a 10% decline. Now, they also said that if a recession were to manifest, Moody's would expect a top-to-bottom home price drop of 15 to 20%. This is what Mark Zandi from Moody's said. Affordability has evaporated, and with it, housing demand. Prices feel a lot less sticky right now than they have historically. It goes back to the fact that they ran up so quickly during the pandemic, and sellers are willing to cut their price here rapidly to try to close a deal. One thing I want to say about this is that demand is on pause. Make no mistake about it. People still wants to buy a house. Mortgage rates have something to do with it, with slowing it down, but so is market psychology. You know, all the talk of recession fears and geopolitical issues across the globe is just downright scaring most buyers, even the ones that can still afford it. Next up, we have Zelman and Associates. If you're not in real estate, you probably have never heard of them. They are one of the experts in the industry. They are expecting a decline of 12%. Again, this is a revised forecast. Prior to this, they were only forecasting a 4% decline in 2023 and another 5% in 2024. Okay, we're still continuing to go down. Next is Zonda, another industry expert or firm in real estate. They are forecasting a 15% decline. Next is AEI, another industry expert. According to Ed Pinto, director of AEI Housing Center, he expects U.S. home prices to fall 15% to 20% from peak to trough. Pinto expects prices to bottom out in 2023 or 2024. Next up is CoStar. Peak to trough, according to CoStar CEO Andy Florence, U.S. home prices will fall by around 20%. People who think a 10% drop in home prices are dreaming. 20% is more comfortable, Florence tells Fortune. I didn't find much on this forecast, so I don't know why this forecast, when you read it, seems to be so confident sounding. Next, we have KPMG. KPMG is an accounting and consulting firm. Another firm that is forecasting a 20% decline. They are calling this a pandemic-induced bubble. Here's what they had to say about this. It was a pandemic-induced housing bubble, which was stoked by work-from-home migration trends. High-wage workers going to lower second-tier middle markets for more space. Once you start the process of prices falling nationally, there is a self-fulfilling momentum to it, because no one wants to catch a falling knife. That's from their chief economist. My comment on this is that the bubble label is being thrown around just willy-nilly. I do not completely subscribe to the notion that what we had was a bubble. Now, you might be asking, why do I say it's not a bubble, or the bubble word is being thrown around? For one, most of the people that bought were well-qualified buyers. Number two, there's a severe imbalance between supply and demand. This demand that we have is real. It's not speculative. So you have true buyers that were in need of housing that was searching for a home. On the other end, on the supply side of the equation, the challenge is not something easily fixable. It's not like we as a society or the government can easily flip a switch and change the trajectory of the supply just by building more homes. There's so many things that goes on with this. And finally, on the interest rate side, yes, it's true there were people that got pushed into buying because of the unusually low mortgage rates. But my argument here is that these buyers were already thinking of buying a home to begin with. It's not like they were, just on this in the sidelines and not thinking about buying a house, and then all of a sudden it's like, hey, let's buy a house. Mortgage rates are low. You see, I believe that what the low mortgage rate environment did for these types of buyers was it just accelerated their plans. In other words, a lot of these home buyers might have been, just on the sidelines waiting to buy in 1 or 2 years for whatever reason, maybe saving up money or not yet ready. But because all of a sudden there was no need for them to save up for a bigger down payment to buy a home and they qualified, they just were able to jump in earlier. I guess what I'm trying to say here is that this is not a typical bubble. It's a more stronger market that's backed by fundamentally sound buyers. Anyway, that's just my 2 cents. Let's go back to the rest of the experts. Next is Yield Street. They said that by the third quarter of 2023, Yield Street expects U.S. home prices to be 20% below its 2022 peak. Quote, obviously, some markets will be less impacted. Markets that will be more impacted are the ones where you have a lot of inventory of new homes like Phoenix, Las Vegas, Dallas, and Boise. These are markets with a lot of construction with a lot of new homes. Those are the markets that will be the leaders in terms of how much home prices decline. There will be some markets in the Northeast which haven't had a lot of new construction where home prices are expected to fare better in terms of declines. This is actually where I think the possibility of the big declines can happen. I mentioned earlier on the video already, Arizona, Nevada, Texas, Florida, and they said also Boise, Idaho here. These are also the same places that got hit really hard the last time we had a mortgage meltdown. This time around, it's not because of bad debts or lack of equity that will bring prices down, but rather because in these particular places, they have more inventory of homes that, for people that wants to buy. And when these homes are not moving, the new construction builders will start discounting them and even possibly wholesaling at companies like BlackRock or Amherst, like I mentioned earlier. Next, we have Pantheon Macroeconomics. I didn't see much regarding their forecast. This is what they said. The firm expects U.S. existing home prices to fall by around 20% from their height of June of 2022. They cite primarily the increasing inventory and waning demand as the reason for this drop. And last, but certainly not the least of all the downgrade or downward forecasts is John Burns Real Estate Consulting. They are forecasting a 22% decline in U.S. home prices. They said that this is based on mortgage rates starting closer to 6% in 2023. They also said this: investors accounted for the highest percentage of buyers ever this cycle in many markets. The lion's share of those investor buyers are now on the sidelines, with some needing to sell given over leverage and really were just taking a flyer on home prices, appreciation continuing to rip higher. Those days are now over, and these sellers don't exhibit the same emotional and behavioral qualities associated with traditional owner-occupieds, which historically keeps home prices somewhat sticky on the downside. The way this sounds to me is that they say that there are a lot of investors, or there were a lot of investors that bought homes and are speculating. There may have been, a number of speculators, but not to the extent that it would tilt the market one way or the other. Last I checked, investors accounted for 15% of transactions, which is about the average. So what do we make of all these projections, and where do I stand? To me, first of all, looking at the San Francisco Bay Area, where I'm from, I see us in the range of 5% down to a high of 5% on average for the Bay Area. Now, on the luxury side of the market, it's probably gonna be more. And when I say luxury, I'm talking about 2 million or more here. Maybe in that price range, we see a 5 to 10% or even 15% decline in prices. On the lower medium home price, I believe that we will be more resilient and we might see some modest price appreciation. At the medium price levels, this is where we see the battle, where it's going to be either going up or going down. So on average, the range would be down 5%, up 5%. Now, the US real estate market as a whole is harder to say because it's huge. I can see the market average getting pulled down by huge declines in markets that we mentioned earlier, or I mentioned earlier. And all these forecasts is really dependent on how our economy is going. If our economy stays the same like it is right now, I believe that prices could be flat to maybe up by 3%. Now, if we suffer through a huge recession, and a prolonged one at that, we can start to see more meaningful price declines. And then towards the second half of the year, this could just accelerate and becomes a crash. I'm not counting on that because I believe at some point there will be a lot of political pressure on the Feds to ease up, to make sure that the party that's in power doesn't get blamed for all these things heading into an election year. Thanks for watching.